Splendid gains if you had the guts to buy it at lower levels. Anyways, let's get in a market voice at that. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, with us on the show. Mr. Subramaniam, thank you so much for taking the time out and being with us. Yeah, we are standing because sitting is the new smoking. Anyways, Mr. Subramaniam, while there is this market at the broader end which is corrected thick and fast, and therefore there is some value emerging, parallelly, at the mid-cap end, there is this market which is filled with stocks which are priced so much to perfection that any small disappointment, the stocks are getting hammered. Mindtree, a case in point. I would reckon that one or two small misses here and there leading to this. Kotak Bank, a case in point. Bajaj Finance intraday, a case in point too.
Yes, I think that's what's happened. It's over the last few weeks, there's been this huge flight to safety. Right, and so any company or a sector which has been doing well and which has got a predictability factor which is very high has seen its valuation scream up rapidly because everybody is chasing the certainty, right? And today, in a fear versus greed kind of situation, it's tilted towards fear, both because internationally there's so much volatility, domestically there's volatility, and we are in earnings season. So I think all these factors combined, this is not a place for the faint-hearted. Okay, now the issue is in terms of the safety. What do you seek in terms of safety? The traditional view of safety is buy value. But today's view of safety is no, even if it's at a higher price, buy the certainty of that earnings. So when companies which have gone up because of that certainty suddenly display the lack of that certainty, the corrections are deep and strong. So safety is a path which is as risky as this path. So that's an interesting thing.
Do you think this trend will continue of paying safety premium, which so far we've seen? Because had it not been for 5 or 6 stocks in Nifty, we wouldn't have seen Nifty at current levels.
Correct. So I think the safety premium will continue for the next quarter. Okay. In my view, because I think international overhang is driven, according to me, by the November elections in the US. Okay. I think a lot of Trump's shenanigans, if I may call it, in terms of flip-flops, tweeting, going trade war, friendly with suddenly the most enemy countries, then enemy with the most friendly countries. All this kind of thing, if you see a pattern, if you discern, is the fact that he is trying to secure his Republican Party vote base ahead of the November midterm elections for the Senate. Because if he doesn't win that, he becomes a lame duck president for the rest of his tenure, and no executive action of the president can pass into law without a majority there. So that's the battle, and I think in the run-up to the November elections, you're going to see even more of this stuff coming on from the POTUS.
As also India.
And India, because the
November elections or the
November elections and the three, as BJP is the incumbent. So the anti-incumbency factor, how far it's going to affect, and what does it provide? It's a semi-final to the final. So I think we are in for a period of volatility in terms of sentiment, and no doubt about it. At the same time, I think for a fund manager, this is a golden opportunity, because when you're tracking quality, and a fund manager tracks quality over a 3-year time frame based on the predictability of the earnings pattern of that company itself within an overall milieu, right? And when that market's in its sentiment is bringing down. They say, that the Narmada river, when it takes up, it takes all the kachra up with it. When it drops on, you figure out who's wearing pants or not, right? So this time is a wonderful time for fund managers to pick quality stocks because they are getting corrected along with the general sentiment, right? So I think that for a guy who's got his focus right for the next 3 years, as a portfolio manager, this is the time. It's not bottom fishing, it's picking the right.
So tell us few, few parameters of identifying those quality stocks which you guys are following.
So first of all, if you look at it from an EIC framework, right, which I call the economy industry company, right? That's the framework to use in volatile times. So economically, what's the thing which is going well? We have a good forecast of a monsoon. We have an election year coming up, which means government is going to spend more in terms of rural areas, in its vote banks and all of that. And third is the government spend on the infrastructure and the road and the rural creation. So what's going to happen in the next 1 year, what is certain to happen is that money is going to be pumped into rural India, and the flip side of that spend is going to mean that some of the things which feed into infrastructure like cement, steel, those kind of sectors will do well. Second, that money going into the hands of the public, with the fact that this Jan Dhan Yojana and the direct benefit transfer means that ultimately the consumer is going to sit with more money, so consumption is going to do well. And when consumption does well, what's the other thing on the urban side? The pay commissions and the OROPs, right? So the tendency to borrow to consume. So if you look at broadly, then infrastructure feed off this. The retail consumption kind of a boom, the rural tilt because of the nature of this. So the next 1 year, you have an economic certainty on these areas. So sectors in these, naturally the valuations are pretty high because everybody is reading this. But if you then look at it, right, to say 3 years from now, what's going to then benefit? Right, is that ultimately this consumption boom is going to lead to increased capacity utilization, and sooner or later the private sector is going to come in and build capacity. When they build capacity, it's the order books of those suppliers of capital goods which are going to go up first. So the market from that perspective is going to start reading that. So if you ask me, from a 3-year perspective, the certainty is that this rising consumption wave is going to mean that capacity utilization is going to rise, and hence private sector capex is going to start. So a good stock from a 3 to 5 year perspective is that which is going to feed off that. So if those today are the ones which have corrected the biggest, if you see the last 6 months, is the infra pack which has corrected the deepest and the widest. But that's where the good quality company, the ones which are positioned to grab this, is what I would call quality today. Yes, in the next 6 months you will see a little more ECG-like movement in their share prices. But if your focus is clear and you're buying these, the investor is going to be laughing the last and laughing the longest.
Interesting. So are you shunning the narrow pyramid of high quality at higher P multiple?
So in a portfolio
investment perspective.
So you look at it this way. So we have 2 types of funds, right? There are sectoral funds which have no choice but to follow the sectors. And then there are the diversified funds, and within diversified there are diversified within a cap curve. Like say mid cap diversified, small cap diversified, large cap. What would they diversify across? These, since they are diversified and since they are open-ended and since they report a daily report card, a fund manager cannot 100% back a 3-year view and sit tight and say, I'll underperform all this while, but there's a pot of gold waiting at the end of the rainbow. So in managing a diversified fund, I have to keep track of the fact that in the short term, the investor is reading the report card every day. So there is a balance between safety and aggression. I would love to be fully aggressive around that quality which I pointed out.
If you had the choice to be fully aggressive.
If I had the choice to be fully aggressive, I would be today in a 30-70 situation, if I had the choice. But I don't think I have the choice. So I am today in a 55-45 safety aggression mode.
Otherwise, you would be only 30% parked in the premiumly valued growth stocks which are at the top of the pile. 70% would be in actual value.
Yes.
As we speak.
Yes. That would be and that's what I'm doing in my closed-ended funds, where I don't have the pressure that my NAV drops, people get worried, call up. No. So I've been consistently launching series of 5-year closed-ended funds in areas like value, multi-cap, emerging small cap. In all of those, I am not only 70-30, I'm 20-80 in terms of aggression.
But so infrastructure is one pocket. Navneet was asking you, what else?
What else is? So if you see within the infrastructure pack, right, there is a capital goods supplier, there's an EPC contractor, there's commodity related to infra, cement, steel, to some extent aluminum, copper, because housing is when it builds up, there's demand for that, right? So you can subsegment. There is industrials. Right? So there's a whole of, I would say there are at least 7 or 8 subsegments within infrastructure which all feed into it. And the biggest bet of this lot is the corporate banks. Because ultimately they've got to finance this. And that's the riskiest bet today, because corporate banking is being where it is. It is the deepest value product, right? But ultimately, if infrastructure and all that I said has to pick up, without bank financing coming in, that ain't going to happen. Try as you might, the equity markets cannot 100% finance it, FDI cannot 100% finance it. Domestic corporate banks and infrastructure financing institutions have to step in there. So that's the deepest value bet that we need to do. And there again, there's a private sector versus public sector split, right? So obviously the private sector is a better bet than the public sector, given the whole issues around the public sector at this point in time. So that's one thing. The other thing in terms of the defensive, see, one of the things which I wanted to point out is that if you see between the GDP components, right, in agriculture, manufacturing and services, this whole correction has happened around the manufacturing side, right? That's the part. And agriculture has held up, though it's dropping share because the good monsoon effect and the consumption effect. But the silent winner in this is the services. Because services is feeding off the infrastructure, transportation, logistics, is feeding off the consumption, retail credit, medical diagnostics, hospitals. So I see that the silent winner in this whole pack, the sneaking guy who's sneaking up and do, is if you have a services. And I must disclose here, right, that end of this month, we are going to file with SEBI, we have got approval for a services fund. So there is a vested interest when I speak this. So end of August, we are coming out with an open-ended services sector fund. The reason I talk a lot about it is because we've done the research for it. And that's why I'm kind of talking about it, but I don't want to go and pitch a fund or anything like that. But I'm just saying that the services sector, to me, is a silent winner, because whether in manufacturing picks up or whether agri picks up, whether this picks up, they are living off that. It's a derivative to that.
Okay.
Right? So per capita income rising means people borrow more, people travel more. So travel, tourism, everything builds up. So a services orientation is one thing which is coming into our funds, and we feel that the time is ripe to actually create a dedicated fund oriented toward the services sector.
Okay, we'll wait and watch and monitor the performance of that fund. But tell us, how are you playing the rupee depreciation theme? We've got the rupee almost once again reaching the 69 to the dollar mark today. So I'm sure most of the funds have bought into IT, which has outperformed this year. Are you still invested? Are you looking to book out? And what about pharma? Can that be a dark horse now in the second half of the year?
Yes, you're right that we have invested in IT, and we got onto the mid-cap IT boom well before it. Today, on the mid-cap, the valuations IT have gone up a little bit, so we're a little bit cautious. But in the large-cap IT space, I think there's still enough room, so we are bullish on IT. Pharma, we are not yet. Despite the dollar helping the sector as a whole, we still believe that within pharma, right, the generics and the product space is still fraught with risk. It's still fraught with company-specific issues, still fraught with regulatory issues, and that. Whereas we are a little more positive on the healthcare and the diagnostics and those kind of, which are more of a retail, more of a lifestyle and those kind of a thing. But pure pharma, we are still underweight the benchmark, and we are not buying pharma just because the rupee is depreciating.
Okay.
As a fund house. So
they have clearly not launched or not in the mood of launching a pharma. It's different from anything else.
Yes, I think that's another takeaway you can. No, I didn't say it, but
we have 2 or 3 new funds launched.
Yeah, which one? Yeah, a couple of competitors launched healthcare and pharma, but my sneaking suspicion is, well, they are called those funds, the actual allocations would go to the subsegments of pharma, which are the safer ones, like the healthcare, the diagnostics, because their offer documents, if you see their offerings, are wide enough to cover these. So they may take a allocation to deep value pharma, but I'm saying there will be also allocation to diagnostics, healthcare, and all of these other safer bets within the broader pharma healthcare space.
Okay, so interesting. Watch out for the services sector fund from the stable of Sundaram. But Mr. Subramaniam, thank you so much for taking the time out and joining us today. And all the best. It was very interesting having this chat with you today.
Sure. Thanks a lot. Thank you.
Well, that's an experienced voice. Their funds have done really well over a long time frame, and now they believe that there could be some value that is emerging at the broader end of the spectrum. Well, in today's session, that may not be the case, but let's find out what's bringing trading value in today's session and start off our conversation for the last 1 hour.